Part 1 of this instructional video is dedicated to Pete Stottlemyre, a true innovator and pioneer without peer. He's so far ahead of his time that he's often difficult to translate and assimilate. I always waited for a quick vertical move in the direction I was looking for before I would make the trade. Break the market down into two functions, fast and slow. That's the objective information. You're looking at a weekly chart of the US dollar index futures in 2015. The most effective way to generate alpha is to anchor your strategic analysis in a higher time frame than the entry time frame. Weekly swings, such as those marked at A, B, and C, provide an ideal higher time frame context for executing entries in a daily time frame. Developing an ability to read and monitor weekly and monthly price action gives one a huge informational advantage as a trader. It provides the time asymmetries necessary for you to develop trades with compelling risk reward. Decimal Strategic is designed to do two things extremely well. One, to isolate high probability and higher time frame trade locations that develop into tipping points for important reversals in a daily time frame, and two, to provide a protocol for calculating risk reward accurately. Decimal is composed of a handful of unconventional technical models that work interactively to generate contextual information. I've been working on this project in various forms for almost 40 years. The algorithms are proprietary and protected. You won't find them anywhere in public domain. First, the clock rotation model. Recall at the beginning of this video we quoted Stottlemyre as revealing that when he was a legendary pit trader, he would key off quick directional moves. And the second quote suggested breaking the market down into fast and slow functions. The clock rotation model is based on a thrust rejection paradigm which allows us to model fast versus slow price action. Clock rotation component of decimal scans for relatively strong up or down bars, then initiates a clock counter sequence composed of 4 units. We use 4 weeks because we want to see how price action develops relative to a rolling or floating month of price action. In essence, we want to read weekly bars relative to each other and the price action around this 4-week clock as a proxy for a floating month. The clock rotation model identified the strong up bar at A and resets a new 4-week countdown and sets an initial performance demand for the next bar as a 20% range extension of the initial thrust bar. This is represented by the red dot plotted just below X. If the price action continues to extend to and above that 20% extension, the action sustains the fast function. If it fails to meet this initial performance demand, it transitions to slow. This count increments week by week to a maximum of 4 unless the clock is reset again. This updated weekly dollar chart now displays Decimal's clock rotation model as it normally appears, red or green dots connected by white dashed vectors. The blue arrows are just for illustration. We see the thrust bar labeled T1 resets the clock and week 1 failed to extend above the red dot at week 1. This failure is an initial sign that sellers may be regaining control. Bar 1 also developed into a minor rejection as it only closed slightly negative on the week and closed marginally below the open. This is a slow rejection, not a fast rejection, and typical of a market entering congestion. The clock model also contains a simple form of vector analysis. Decimal increments the clock to 2 for the next bar and draws a clock vector from red dot 1 to red dot 2 as illustrated by the blue arrow. Not only do we assess the price action in the 1 and 2 o'clock position for fast versus slow rejection, but we also consider how the high of the week is developing relative to the 1 through 4 clock vectors. Notice as the dollar moves to the 3 and 4 o'clock positions that price is clearly in a slow mode, which is neutral and defines congestion as the price action is both above and below the clock. The key point is when the clock is ticking, it defines definitive price levels for monitoring near-term sell-side or buy-side control because the price action during a given week will develop fast or slow and above, below, or around these clock vector points, allowing you to read at a glance who's in control or if the week is just balancing in a congestion or indecision. Now notice the clock has expired at 4 and Decimal is scanning for a new thrust bar up or down to initiate a new clock sequence. At bar T2, price now transitions from slow to fast and begins to exit the congestion as the new thrust bar at T2 is fast, closing strong for the week near the high and clearly above its open print. This resets the clock again and decimal plots a red dot range extension target at the white arrow. Notice price continues in fast mode and blows through this target, which is indicative of strong buy-side control or trapped sellers forced to cover. As the weekly price action continues, notice thrust bar T3 resets the clock again and decimal plots a red dot range extension target near the white arrow. But the dollar remains fast and buyers remain in control as price blows through the target again and the clock is reset again. However, thrust bar T4 becomes a price too high as buyers fail to reach the red dot target in the next bar and price is rejected sharply in bar 1 at A. However, by the end of the week, price bounces sharply to close above the midpoint of the week, which mitigates the initial fast rejection. As we move forward in time, notice the retest of the high at T5 is a new thrust bar, which resets the sell side clock. The rejection bar at A, with the clock count reset to 1, is clearly fast and potentially bearish. Buyers failed to extend that week, followed by the bar closing sharply below the open and negative on the week. And notice the spread between the high of bar 2 at B and the clock vector is increasing. Hard selling occurs in the next bar at C, but notice this bar creates a thrust bar down T6, which begins a buy side count of 1 for the next bar. Buy and sell side clocks can develop at the same time, reflecting a two-sided market. The bar at D is slow and neutral. Buyers defended the range extension at green dot 1. However, the bar also closed below the open and negative on the week. In bar 2, notice buyers need to defend the clock vector at 2. That's their performance demand, but they failed, forcing trap buyers to liquidate, creating a fast thrust bar to the downside at T6. This resets the buy side clock and starts a new count. Buyers then take clear control at E with a very fast rejection to the upside. Notice the bar at E is strong enough to actually reset the sell side clock, bringing sellers overhead at red 1 and 2 o'clock vectors. Meanwhile, buyers are below at the green 2 and 3 o'clock vector. This equivocal configuration of sellers overhead and buyers below creates a conflict and messy price action until either clock expires or a new clock reset develops. So far, you've learned how to read the clock vector model. Now we move to the yin-yang dynamic model. Notice Decimal Strategic is now plotting bars painted red and green at A, B, and C. These bars are generated by the yin-yang dynamic model, which scans for bars which suddenly change character as measured by relative rates of change, variance ratios, or other behavioral metrics. These yin-yang bars can be initiating price events such as breakouts and often imply range extension. They can also be exhaust or termination bars depending on context. The green bar at A is a breakout bar separating out of the red dot congestion on the left. It has a good deal of swing freedom to the upside as there is no overhead resistance. The red bar at B is the same type of bar to the downside, but there's structural support below which limits the extension. In the yin-yang model, if a green bar develops out of congestion, they create future downside targets for future rotations or corrections back to test the low of the green bar or high of the red bar, unless these bars are too far away from the congestion they're breaking out of. In this refreshed view of the dollar, I've manually drawn yellow rectangles around decision-indecision or congestion areas. These also define areas of slow versus fast price action. In the yin-yang dynamic model, these green bars are also called tree bars and the red fire bars. Below green bar A, I've drawn a white line extending from the low of the green bar to the right. Notice the low of the green is close to the most recent 4-bar or rolling monthly congestion, highlighted by the yellow rectangle. Notice the steep correction off the high, corrected back and was then defended in this zone. At B, I boxed in the prior monthly congestion as well and drawn a white line extending from the high of the red bar to the right. This zone also provided overhead resistance to the rally from the May 2015 low. But notice for the green bar at C that the low of that green bar is removed from the boxy congestion. Therefore, in such cases, support would be drawn at the top of the rolling monthly congestion and or at a retrace to the 3 or 4 o'clock vectors. To review, tree and fire bars provide crucial market-generated information that suggests range extension and define support and resistance targets for swings that develop forward in time, and the rule is these bars must have lows or highs close to transitional levels from slow to fast. In this new image of the weekly chart, Decimal Strategic is now plotting a third model. It's one version of our semantic pattern recognition model. The white cross with the black dot at B was plotted as of the close of bar A, while the white cross with the black dot at D was plotted as of the close of bar C at the end of the week. Semantic pattern isolates and flags weeks where tipping points occur, where minor localized price action in the daily or intraday can develop into important reversals in a higher time frame. In this same weekly chart, we now have the full complement of decimal models working interactively, and the components are shaping up to develop a long-side trade idea for the dollar index. Note at X in the red box, two conditions are present in combination. The white cross black dot, which is the semantic pattern alert symbol, appears. This was plotted forward one bar as of the close of the prior bar marked A. At the same time, a buy-side vector was possible as buyers were now below at the green dot range extension target with the clock reset at 1. This specific combination in the red box, where buyers are below at 1 o'clock with a semantic pattern cross also below in the same bar, isolates a ripe context for important reversals. If validated by local price action, meaning a tactical daily entry during the week labeled 1, we would go long assuming other conditions are in play, which we will review in part 2. Of course, we reverse this logic for a short. This definitive combination is called the Decimal Strategic Alpha 1 algorithm for swing trading. Note at the bar labeled A, 1 week earlier, this same Alpha 1 pattern combination was in play on the opening of that bar, as buyers were just below at O, with a semantic buy also below at a lower level. But the price action that week in the daily developed to the downside, ruling out an entry. The semantic pattern model will often issue a cluster of signals at a pivotal location, and premature signals are normally filtered out by an absence of a validating entry at a tactical daily level. This Alpha 1 pattern at X is extremely powerful and timely. You can build an entire standalone investment or trading program for Forex, stocks, or futures around this one pattern alone. Whenever they appear on your decimal weekly charts, you can stock a short or long with a high level of confidence. Simply plug in your current tactical entry protocol when Alpha 1 surface, or use them to identify when to be more aggressive in terms of sizing. Those who have taken the Trend Dynamics course or studied Trend Dynamics tactical entries can stock along using one of those entry protocols outlined in the course. However, the decimal Alpha 1 algorithm is so powerful that any effective entry technique that can reliably isolate a developing swing bottom will be effective. Note at Y and Z I've added a 40-week or 200-day and a 45-week or 1-year moving average just to frame up this weekly price action in the context of long-term uptrends. This concludes part 1, which is a quick start intro to reading weekly price action through the lens of Decimal Strategic, and which explains the Alpha 1 swing trade condition for optimal trade location. In part 2, we complete the last piece of the puzzle by teaching you how to identify high probability levels to exit the trade, which then sets the stage for learning how to use a risk-reward grid and define risk-reward ratios within the context defined here. We'll see you soon in the must-see risk-reward tutorial in part 2. Decimal is state-of-the-art software for trading Forex, stocks, or futures. Prior to July 2015, it was only available to institutional traders. A retail version of Decimal is available at Stock-Zen.com. If you want to learn more about the Trend Dynamics trading course or Trend Dynamics tactical entries, go to the Stock-Zen homepage and click on Resources at the top, then select the Publications and Playbook box, or just navigate to the URL listed below.